So
I just need to say that Vidhu, you're keeping time for Rajeswari, and Rajeswari will be keeping time for you.
And considering Yesha being the conference organizer, ate into a lot of our time, so we just have we're just going to eat into lunchtime now.
Yeah, you can.
Okay. So I want to thank the conference organizers, first of all, for organizing this hybrid event, because I can't begin to say how wonderful it feels to actually be physically present in a room full of people and present a paper, as opposed to sitting in pajamas with a formal shirt and presenting in front of Zoom, where the feel is just not the same. So thank you so much for doing that. And on a serious note, of course, thank you for including our paper in the program. It's particularly useful because this is preliminary work. So any comments and feedback that we get is going to be very useful. Also have to make a disclaimer. This work was done with financial support from SEBI, but does not reflect SEBI's views. This is jointly done with Harsh, who's in the audience, who will be taking all the questions. Okay, so it's not new to this audience, of course, that for the last several years, we have had a dozen committees talking about development of bond market in India. And we have come a little bit. It's not like nothing has been achieved. For example, what I'm showing here is data on primary issuances taken from a CRISIL report in the corporate bond market from 2010 to 2020. And what you see here is that the total volume of outstanding, if you can't read the numbers, it has grown fourfold from about 8 trillion in 2010 to about 32 trillion in 2020. And last year it went up to 35 trillion. So there has been a significant improvement in the size of the corporate bond market, even in terms of issuance, it has grown. But of course, there are issues, there are many, many issues. And one of the most important issues that we plan to explore in our paper is pricing. Now, pricing of a security is, of course, one of the most fundamental functions of a market. And if there are problems in pricing, that itself points to the fact that the market is inadequately developed. This is a graph from an earlier work that Harsh and I did last year, where we were interested to understand the evolution of the credit spreads after the default of a big NBFC, the ILFS default of 2018. This was published in the Lee blog. What we found is that after the event, and you see that vertical first line, which is the ILFS default, here we are showing you the credit spreads. This is again primary data from Bloomberg aggregated. And what you see is that for the similarly rated paper, which are all AAA rated bonds and all of similar maturity, 5-year maturity bonds, there's a big difference, a big variation in credit spreads depending upon who is issuing the bond. So for example, on the top, you have the NBFC AAA rated 5-year maturity paper, which of course just shot through the roof because it was after the default, followed by the corporate bond issuance. And at the very bottom, you have the bonds issued by the public sector enterprises or the government-owned companies. But what we are trying, and what really caught our attention, is that for bonds which are similarly rated, implying that they're carrying similar credit risk, and they have the same maturity, which is 5-year maturity in this particular graph, there is such a lot of variation in the credit spreads, and it persists over a period of time. So roughly speaking, in the vertical axis, the variations are shown in basis points. There are almost about 100 to 150 basis points difference between paper which are rated similarly and of similar maturity. And this was while we were only looking at the post-ILFS period, we found that even when we go backwards, this kind of a difference persists. And that is what really triggered our interest to understand what is really going on as far as pricing in the bond market is concerned. And of course, mind you that this is primary market data, because in India, there is no liquidity in the secondary market, in the secondary corporate bond market. So we don't look at the secondary market, we look at the primary market. But that is unique in and of itself, because even in the primary market, the investors, it's useful to understand how the investors are passing the information that's available to them and how they are pricing the bonds. So what is it that we are trying to do in this paper? Now, as we understand that corporate bonds primarily present two kinds of risk. One is the credit risk and one is market risk. Credit risk is summarily captured by the credit rating of the bond, which in turn reflects the default probability. And the market risk or the interest rate risk gets captured in the maturity of the bond. Of course, there is also a third component, which is the liquidity risk. But given the fact, as I said, in the secondary bond market in India, even the most liquid bond is hopelessly liquid. So we can safely assume that the liquidity risk is the same across the entire corporate bond market spectrum. So primarily, we have the credit risk and we have the market risk. The credit risk gets captured in the credit rating. The market risk gets captured in the maturity of the bond. Now, the no arbitrage theory will tell us that once you have accounted for the maturity of the bond, then the only factor that should determine the credit spread is the default probability. So once the default probability is taken into account, that should pretty much explain in its entirety all of the credit spread. What we are trying to understand is that really the case, or are there serious anomalies in the pricing of the bond? So two main questions that we look at: is there persistent and consistent evidence of pricing anomaly in the primary corporate bond market? And the answer to that is yes. The data that we have used, we show that there is indeed consistent evidence of anomaly in the pricing of corporate bonds in the primary market. And the second is we try to understand, instead of just looking at it graphically in a descriptive manner, is there a robust analytical manner to establish this? And we find that there is. And when we apply that method, even then we do find that there is evidence of a pricing anomaly. So what we do is, this is basically the bulk of the work that we have done pretty much for the last few months, which is tediously collect data on every corporate bond issued, and these are all listed bonds, every corporate bond issued over an 11-year period from FY 2011 to FY 2021. And I want to thank Surbi, who's present here, who's really helped us a lot with the data work, and there's another intern at IGIDR. What we have from these databases, and this is from the NSDL website, where we manually collected data on every bond issuance. We have data on the issuer, who's issued the bond, what is the ownership of the issuer, whether it's a public sector issuance or a non-public sector, whether it's a finance, meaning primarily an NBFC or a non-finance, what's the issue size, what's the coupon rate, the maturity period, and of course the credit rating. So we have roughly about 13,000 issuances over this period. For the paper, we use data only from FY 2017, mostly because the data before that is sparsely populated. But going forward, we want to use the entire universe of the data available just for the sake of completeness. What we have also done is, for most of the time, what happens is, for a particular bond issuance, it gets rated by multiple credit rating agencies. And what we have done is we consider the highest rating that is given to that particular bond issuance by the rating agency. We consider for this the biggest, the most accredited rating agencies, which is CRISIL, ICRA, and CARE. And there are also some minor rating agencies that we might consider going forward. So that's basically the data. And I want to show you a couple of graphs to describe what the data looks like. And by the way, this, to the best of our knowledge, is the most extensive data set on primary bond market issuances collected so far and used in research. We were really surprised to find that in the literature specific to the Indian bond market, there is no such work that has been done using primary bond market issuance data. And the reason why I don't cite literature here, which is a very conventional practice for a research paper, is because there is a big difference between the literature, which is primarily focused on the developed market, where all they're looking at is the secondary bond market data and understanding the yields and credit spreads in the secondary bond market. That, of course, as I said, does not apply to India, because we are at a very preliminary stage where we are just beginning to understand what's happening in the primary market, and there is no liquidity in the secondary market, 0.25% liquidity in the secondary market. And if I look at the Indian literature, there is no comparable study that has looked into this issue. Now, this graph shows you the share in the volume of issuances over the last 5 years. And what you see is that the blue bars show the share of the public sector issuances. And what I want to highlight here is the preponderance of public sector issuances in the overall primary market issue, right? It's almost close to 50% of the issuances are done by public sector enterprises. It's almost like a, loosely speaking, market capture by public sector issuers. And here it's the share of the finance firms, which are almost entirely NBFCs. Even within the NBFCs, by the way, 50% are government owned. So there is a huge amount of what we call quasi-government borrowing going on in the primary bond market. And we will see how it is affecting the pricing anomaly as well as we go forward. This shows the volume of issuances in the primary market by rating categories. And if you focus on these first two verticals, the bubbles, you see that most of the issuances are, of course, done by the AAA and the AA rated companies, which is, of course, not a surprise. I want to highlight a weakness in the data just to be completely transparent. There is this last bubble column, which is the NA. Now, there are a lot of about 2,300 bond issuances in our data set, which are unrated, which when we got it from the NSDL, they are not rated by any particular credit rating agency. We have talked to bond market participants and got a sense that we can safely assign a rating of B to all of these NAs. But what we plan to do going forward, just to make our lives a little bit harder, we want to tediously collect individual rating for each of these bond issuances to be very, very accurate about the credit rating that we assign to them. And we have done robustness checks by assigning B an average of BBB, B, etc. The results don't change by and large. So this is one of the most important graphs of the paper, right? What I'm showing you here is we have bucketed the primary issuances into different rating categories and into different maturity buckets. And we want monthly data to understand the pricing anomaly in a descriptive way. Most of the AAA rated bonds are the ones which give us consistent data on a monthly basis. So that's what we are showing you here. This is the difference between the best priced and the worst priced AAA rated bond of different maturities. So you have on the top, it's 3 years, then 5 years, then 10 years. And this is, the data is from about April 2018 to March 2021. So we're showing you a snapshot of the kind of pricing anomaly that we're seeing in the data. Each graph here shows for that particular maturity bucket, what is the difference between the best priced and the worst priced AAA rated bond. So essentially what I'm saying is that even for bonds which are identically rated and have the same maturity, there is on average a 200 basis point, 2 to 2.5% difference in pricing, which was stunning to us. If I look at a benchmark in the US, anecdotal evidence says that average pricing anomaly is not more than 5 basis points. We are seeing something close to 100, 150, in some cases 200 basis point pricing difference between bonds which are identically rated and of identical maturity. And of course, you see there's a bit of a time variation as well. Somewhere after the ILFS default, it's the 3-year maturity paper where the pricing anomaly is higher, for the 5-year it's lower. So of course, there are some macro liquidity conditions which could also be impacting it. But this confirms what our suspicion was, that there does exist pricing anomaly in the primary bond market. This is again a summary just to basically drive the point home that when we take an average of the difference between the best and the worst price bonds in the AAA rated category, we see that for the 10-year maturity, on average about 1.16%. For the 5 years, it's 2.7% is the pricing anomaly on average. For the 3 years, it's 1.7%. Not only that, we also find that the best priced bonds, meaning the bonds with the lowest yields, are consistently issued by PSU government-owned enterprises. In the finance sector, for the NBFC bonds, when they're government-owned, they're best priced. When they're private-owned, they're worst priced. So once again, that points to the fact that there is an implicit privilege that government-owned issuers are enjoying in the primary bond market. What we show here is that, and I'm going to wrap up in the next 5 minutes, can we establish this pricing anomaly in a more robust analytical manner? What we do is that for this, we calculate the credit spreads for all issuances. And by doing that, what we're doing is we are accounting for the maturity automatically, right? Because we're deducting the yields on the government securities of corresponding maturity from the corporate yields of equivalent maturity. Now, as I said earlier, that credit spreads in the absence of pricing anomalies, once you have taken into account the maturity and assuming that there is no liquidity risk, credit spreads should entirely be determined by the default probability of the bonds. And the idea is that the higher the default probabilities, meaning lower the credit rating, then the higher should be the credit spread. Do we find that there are factors other than the default probability that's also impacting the credit spreads in the primary market? Once again, when I look at the literature in the West, most of the determinants of credit spreads that they are looking at are macro determinants, because my sense from the literature reading is that they can't even imagine this kind of a pricing anomaly. So they're not even looking at issuance specific factors that might impact the credit spreads. So as I said, influence of other factors on the credit spreads would potentially point towards the existence of a pricing anomaly. One number, this is the full sample of 7,455 issuances. We find that when I look at the full sample, yes, there is a positive association between default probability and credit spread. And when I say default probability, what have we done? We have matched the credit rating of each bond with the corresponding default probability by getting data from each of the credit rating agencies. And for now, we have taken the average default probability assigned by all those 3 rating agencies. Going forward, we want to be again meticulous and take default probability given by each and every rating agency. So we find that yes, an increase in the default probability is going to increase credit spread, which is exactly as expected. But the story does not stop there. We find that over and above default probability, issue size is also statistically significant, as is maturity period. I'm not going to talk about the economic magnitude of the coefficients because that's not where we're interested right now. We just want to see from a very basic statistical significance point of view, do we find other factors impacting credit spreads? We find yes, the greater the issue size, the lower the credit spreads, the longer the maturity, the higher the credit spreads. basically imply that investors in some sense are penalizing bonds with a longer maturity, even if they carry the same credit spread. We also interestingly find that when we account for dummy variables, which are capturing PSU issuers and finance issuers, those are also statistically significant. Particularly for PSU, the credit spreads seem to be lower than the non-PSU issuers. So we want to delve a little bit deeper into this. And we find that the second column, very interestingly, default probability does not seem to be relevant at all for deciding credit spreads of PSU issuers. And this result remains if you slice and dice the data, truncate the sample, whichever way we are looking at it, which implies that investors are not interested in looking at the default probability or the credit rating of the PSU issuers. There is some kind of a pricing advantage clearly that the PSU issuers are experiencing. However, when we look at the non-PSU issuers, which is the third column, once again, we find that default probability does matter for credit spreads. So if you take away that implicit advantage that the PSU issuers are enjoying, we are back to that intuitive explanation, the default probability should matter for credit spreads. Again, if we go down, we see that issue size is important for the non-PSU issuers. Maturity period continues to be important for the PSU issuers. When we look at just the finance sample, counterintuitive result, we see that higher the default probability, lower the credit spread does not make sense, which could be a result of the fact that majority of the finance issuers are disproportionately overwhelmed by PSU issuers as well. And that is something that we want to dig deeper going forward, but this definitely is a counterintuitive result. But by and large, we see that factors other than default probability definitely have a statistically significant impact on credit spreads. And the PSU issuers seem to be enjoying some kind of a privilege in the primary bond market, some kind of a benefit when they are pricing their bonds. I don't want to pay too much attention on the R square because there could be other factors, particularly macro factors that we have not accounted for. But I just wanted to show you a snapshot of if we just account for the variables, the factors we're getting from the primary market bond issuance data set, what is the result we are finding in terms of determinants of the credit spread. So what are the implications of this? First of all, as I said, it raises questions about the credibility of the credit rating. If we assume that credit rating is going to be a summary signifier, a summary indicator of the credit risk, of the default probability of a particular bond, we see that investors are not paying attention only to the credit rating, they're also paying attention to other factors, which, as I said, points to a potential anomaly in the pricing. Second is the PSU issuers are enjoying a subsidy in the bond pricing, which can also point towards a kind of crowding out of private sector issuers because they're enjoying the subsidy at the expense of the private sector issuers. And third is we see that there is persistent anomalies in the primary bond market pricing. And that, of course, distorts the very fundamental function of a market, which is price discovery. So while we talk about very big ticket issues in the development of bond market, there are fundamental issues in something as important as pricing that the regulators and the policymakers and the academic community, etc., need to pay attention to. And of course, there's a much more scope for further research that we plan to do. For example, this is my last slide. We want to understand, do pricing anomalies go up during conditions of tight liquidity? So for example, in the aftermath of the IL&FS default, when there was a liquidity problem in the market, we did see that there was a big increase in the pricing anomalies. And of course, when the lockdown was announced, the anomalies just exploded. It went up to more than 200 basis points. So we want to understand how does a macro factor like liquidity impact this pricing anomaly. The second is, do pricing anomalies go up after negative events? Similar to what that first paper in this session was explaining. For example, once again, a default by a major entity like an IL&FS, etc., can some negative event like this impact the pricing anomaly in the securities market? One caveat I want to say that somebody may say that yes, PSU enterprises will enjoy a benefit because there's a liquidity advantage that they have. But as I said, even the most liquid bonds in the secondary market is hopelessly liquid. So that's not really a satisfactory explanation as to why the PSU bonds are enjoying a benefit of pricing. It clearly points towards some kind of a subsidy, implicit benefit, even if they don't have an explicit government guarantee. That implicitness that because they're a government owned is giving them an advantage in bond pricing at the expense of the private sector issues. So I would end here, and I'm guessing I'm on time. Thank you so much.
Yeah. Thanks, Rajeswari. So, when Susan asked me to be a discussant here for this is the first time I'm being a discussant for any paper, in my short life. So, and usually I don't go beyond the first 2 pages, right? So when I see the equations, I just skip to the end. But I saw that this was an important paper, and it was a short paper, and I could actually understand what they're talking about. So I said yes. So having said that, I think this is an important first step in an important area. What we find usually is that we have all these committees, and the committees generally don't base their prescriptions on real research, right? And it is quite surprising that we don't have sufficient research to inform policy making. And we were talking about this issue before, that there is a real need to examine a number of different issues, and this is one of the issues that we're getting started with. We probably need a full research program for the corporate bond markets. Now, it's good that we saw the China paper before that, and there seemed to be a lot of similarities between India and China. And one of the thoughts that I had while I was reading this paper was that we need to compare India not just with China, but with other markets as well, to see what do we observe. A very important thing, a couple of things which struck me as I read this paper. First was that we are starting off with this apparent anomaly, right? That the credit spread should depend upon and depend only upon the default probability as represented by the rating. Now, the rating is a blunt tool, and rating agencies have come under a lot of criticism during the course of this day today. And we'll come back to the discussion on how useful ratings are. But then, having said that, it should depend only on the default probabilities. We find in the regression that it depends on anything but default probabilities. The statistical significance is quite low, and anybody who has been in this market would have said that, oh, why do we even need to do this research? We already know the answer to this, right? So anyone who has who's been at the who has done anything in the market knows that these bonds are priced very differently. So what is missing, right? So this is an anomaly, but it is an apparent anomaly, and it seems to us that it's an anomaly because we are not looking at the other side. So it takes two to tango, right? For every buyer, for every seller, there has to be a buyer. And I think the answer to many of these questions would be found if we look at who the buyers are, right? And the buyers, we will find that the buyers for the public sector bonds are different from the buyers of the private sector bonds, or the preferences of the buyers, the constraints of the buyers, the policies that the buyers operate under, that those are the ones that we need to look at if we want to understand why there is a difference between the credit spreads of different types of bonds. And I think that's where this paper needs to go. And without looking at that, I think the story is incomplete. So I would expect the authors to at least have some discussion on who holds what and so on, and what are their preferences. Now, one thing which we know is that in the last 4 or 5 years, mutual funds have emerged as major buyers of corporate bonds, and we could probably see some clues in to what they are buying and how, when you look at the evolution of the spreads, what's going on there. And they are also very sensitive to, because they are sensitive to their investors, they're also sensitive to what is happening in the market. So if you do the pre and post ILFS and so on, there will be a lot of clues as to why we are seeing some of this, these things that we see. I would like also to see a lot of the analysis is about extremes, that is the best price bond versus the worst price bond, but I think the extremes sometimes don't capture. We probably need some interquartile ranges and things like that, some other measures of dispersion, some more graphs which show us that. We may get some more data, but I think we will see a lot of insights simply by looking at the descriptive statistics. So, so this is what it is. I really think that we should do some comparison between countries to see and between and over a period of time. I think Harsh was talking yesterday in the panel about the various regimes that we have gone through, right? And maybe if you look at the way these spreads have behaved in the, I think we can't really go back all the way back to the old IDBI, ICICI, the development finance institutions, but even within the last 20 years, there would be different regimes that we can look at. So there's lots and lots to explore. Great topic and great beginning to a good research program. Thank you.
Great, thank you. Thanks, Vidhu, for having been the first time ever discussing for this conference, for this paper. Rajeswari, would you like to respond?
Yeah, so thank you so much, Vidhu. Very, very useful comments. And I'm glad that as the first discussant to discuss our paper. But I quickly want to say that, of course, it would be a dream come true to be able to compare the Indian primary market bond problems or pricing problems with other markets. But particularly for emerging markets, as you can imagine, the data availability is a very big constraint. So what we are first trying to do is, as a benchmark, try to look at the US bond market data to see that what is the extent of anomaly, if at all, that exists in the US. And then come a little bit to a different part of the horizon, and then maybe look at other countries like China, etc., but where the data constraint is going to be a problem. But that's in the works. The second thing is, while it's well known amongst the bond practitioners maybe that there exist these kind of anomalies, but I think it's extremely important a value addition to document that in doing research and using data and analytical methods to show that indeed that is the case and that has persisted over a period of time. So I think that kind of perspective is extremely valuable. Third is, yes, we can definitely look at the bias. That's an excellent suggestion. And Harsh just confirmed that we do have the data on that. And that's something that we will look at. Fourth, yes, we are looking at extremes just to give you a sense of what the anomaly looks like. In the paper, for example, if you've seen the summary statistics, we have reported standard deviation for every rating category for controlling for maturity. And we do see that the standard deviation is actually quite high across similar rated and similarly matured bonds, which does point towards, again, what you're talking about, the dispersion. But yes, we can look at interquartile dispersion as well. Lastly, various regimes. Of course, as I said, the next plan is to look at liquidity regimes, monetary factors, macro factors, etc., and see how the spreads, how these pricing anomalies may have changed over a period of time across these macro conditions. Thank you.
So I'll just add two quick comments. So we know the investor pools, right? And they are what I call sequestered investor pools. So for example, EPFO will only invest. EPFO is a large pool. It owns probably about, my guess is about 15 to 20% of all corporate bonds. And no EPFO fund manager ever had a vigilance inquiry against him or her for investing in a PSU bond, however bad. So that's the issue that we have. But I don't think that still fully explains. The anomalies is too large. The one thing that I kind of sort of eyeballed the data, which is pre and post IBC, Susan, you would love this, because with the bankruptcy law, you would have imagined credit rates generally to come down. They haven't. So despite the fact that there is a greater bondholder protection now, theoretically, haven't statistically looked at it, but my guess is that we may not get support for that. The spreads are where they are.
I'd love it if you said this to all the people who are rushing out and writing papers on seeing the effect of the IBC on credit behavior. No, but thank you very much. As I said, we like the paper. When we looked at this paper for the conference, we thought this was the need of the hour. It was very critical and important and great. So I think there are some questions on the floor. There's Ajay and Shorish and now Arvind. Can we take it in this order, please? And
let's first a quick comment on the OLS regressions on credit spread. The best way to think about a corporate bond is through the Merton model, where there is an option-like relationship between a corporate bond and equity, and that leads to very nonlinear relationships. So I just don't like when you have a linear model and you want to think of the credit.
But our
spread.
independent is default probability. It is not, so that captures nonlinearity. So because our default probability is nonlinear, it's step function.
I need to work it out, but it's not linear. Okay, so just worry more about linearity. And my second is not about this paper, but just thoughts about where to go further with this. So I feel a major organizing principle that we should all be using to think about Indian finance, and that's what's distinctive in a developing country setting as opposed to a developed country setting, is that systemic risk is always at the door. So if you think of an IMF, FSB, BIS definition of systemic risk, it's the disruption of the market system in ways that impair real world business uses of finance. Okay, this happens once in 30 years in London and New York. It happens once every 30 months in Bombay. And so that's a great organizing principle, that this is a country where the wolf is at the door, the systemic risk is upon us every day. Every now and then the market gets disrupted and reasonable normal business activities get disrupted. Good projects don't get funded. The firms are running around trying to deal with some external mess. The firms don't get the luxury of focusing on their own life, on their own business plan. The firms are responding to some big mess that happened outside. So we can catalog one after another, the disasters keep unfolding. I think that's a good organizing principle to think about. And then this data set can be used very effectively for that. And while ILFS is high on our minds, but that's just our recency bias. If you drill further into time, there's just been, one problem after another all the time. And so in that, it's interesting and important to ask that what's the class of firms that gets rationed? So what's the class of firms that just had to suddenly do an abrupt deleveraging or lurch into default when faced by the ILFS problem? In the primary market of the bond market, you will see that sudden stop. You will see firm by firm.
Yeah.
Harsh, Rajeswari, we've been talking every step of the day. We've been talking every alternate day through the events of the last few years. And we know the story as it unfolded, that the bond market basically just pulled off a sudden stop on a large class of issuers. Your data set permits that identification of where was the sudden stop. So the international finance metaphor of a sudden stop is being brought to bear here in India on a firm by firm basis, that some firms live and some firms die. And the bond market choking in the primary market is a nice measure that either you get refinanced
or you don't,
or you go bankrupt, or you do a very unpleasant deleveraging where you sell your best assets, oftentimes taking a very bad discount. And this is the lived experience of what life is to be inside one endless systemic crisis after another. And then you come to causes and consequences. What are the firms that get choked off? What are the firms that don't get choked off? How does it play out into equity financing? What is an optimal corporate financial strategy for a class of firms that cannot count on consistent financing with any reasonable possibility in coming days? Blah, blah, blah. So there's a whole bunch of questions that flow from that what does it mean to be living in a country where these acts of God keep on recurring? Because I feel that's like a fundamental organizing principle to think about Indian finance, that we go through a systemic crisis every 30 months. This is a country where systemic risk is every day.
But also, Ajay, it's equally important, at least for me, that we talk about government crowding out and financial repression in the banking system. There's a serious financial repression in the bond market. You can actually compute the rupee value of subsidy that the NHI gets. NHI projects on a standalone rating will not even get a single B rating. They raise money at AAA and over many private borrowers who will be AA and so on.
And
so I think
if I may just add to that, I think you told me, or
I told you,
somebody else in this room told me, the FRBM has, and we hold you responsible for all the ills. The FRBM has a clause of some 1% of GDP
has a guarantee limit
on guarantees. So the NHI does not have guarantees.
No, there's no explicit guarantee. I've checked. The bond papers don't have contracts, don't have guarantees.
It has a comfort letter.
It's just an implicit guarantee.
Yeah.
Even without a comfort letter, implicit letter, just the ownership.
In NHI is unique case because it raises money for SPVs, which are specific projects, road projects, which is not even NHI, and they get money at AAA when their financial, in my opinion, justifies single B. They are just about covering interest payments, if at all. Sorry.
Sharish?
So Ajay has taken my first point that OLS regression. I'm really uncomfortable with that because we do know it's a very non-linear, but the way Ajay is suggesting to go through a Martin types model also will be very difficult to develop all the mathematical integrity. It will take a long time. So rather, my suggestion is what Vidhu is suggesting, that look into the market microstructure, that who is buying the government issued bond and who is on the corporate buying the corporate bonds. And that microstructure is the cause of price inefficiency. We do know actually who is buying, right? So if you develop your statistical model from the market microstructure point of view, that will be much more solid model, more solid statistical model than this particular model. And second point that I would like to make, as a pure statistician, not as a economics or any finance point of view, pure statistician point of view, there is a saying that if you torture the data enough, it will surrender. So I see this analysis as being a prime example of that. You have sample size 7,000 something, and you have how many parameters? 5, 6, 10. If you have so many samples, your null hypothesis will be rejected, no matter what. And how do I know that? Because you've adjusted R square is so small. So all these things are absolutely red flag from a pure statistics point of view. Absolutely red flag. I mean, I would not buy anything from this model.
Okay.
So that is just a pure statistics comment.
Thanks, Shorish. Arvind?
Yeah.
And then we have Yesha.
Okay, 5 quick points. The PSU subsidy is there. I mean, as an investor, liquidity is what I derive. So there might not be secondary market liquidity, but I know that if I have to sell, I will easily sell a PSU bond because the acceptability of PSU bonds is larger than private bonds. So that's why there is a subsidy. And PSU bonds are a separate asset class. So you cannot say corporate bonds. PSU bonds as different.
It's quasi-government.
It's quasi-government. There is perceived liquidity. There's perceived safety. NHAI, as you said, I don't look at NHAI financials. I know it's a department of the government. FCI similar, no guarantee. But so when you categorize PSU is separate. Even PSU finance, right? It's a separate category. The anomaly that you saw, yes, I think it's great. The market is responding to a situation, and that's why the difference in credit spreads. One reason for that, as Vidhu pointed out about the buyers, India is a very homogeneous market. All buyers at any point of time have similar liquidity constraints or event risks and are very similar in terms of view. We do not have yet
Heterogeneity of
different aspects. The heterogeneity comes with someone like EPFO who does not care about near-term liquidity and can own bonds and hold. But the market is still very homogeneous in terms of views and direction. The third on the unrated paper, unrated 2000 bonds, use bank loan ratings. Bank loan ratings are available on everything. So use that as a substitute for the bank loan ratings. Every bank loan is rated. So
but it's not publicly available. I tried that.
CRISIL is not giving it.
No, it's not.
It is there on the website. On the outstanding ratings you'll get.
No.
Search the bond.
No, bonds.
Search the company. Yeah, search the company. The bank loan rating will be available on the CRISIL website. Outstanding ratings have to be given there. Primary against secondary. So you are looking at primary market data. You can continue that in the secondary market. You don't need secondary market liquidity, but the pricing of secondary market bonds are now available by CRISIL ICRA for payment because all mutual funds are using it. Not very good, but mark to model.
It's all model-based pricing.
But it's still, there is a pricing and the entire industry is using it. And the secondary market activity is kind of priced based on a model price that I already have. So you can try and see if it works, but it is available. But for a payment, it's expensive.
It's not true market price. It's a model-based price.
But that's the nature of a corporate bond market. Okay. I mean, there's no liquidity. Yep. Thank you.
Thanks, Arvind.
So I want to quickly respond to what Shorish said. So absolutely valid point, and it's well taken. But I guess the idea, first of all, was even if you just look at the graphs, you do say that there is a problem that is happening in the pricing of the primary bond market. But I do agree the challenge is how do we establish that? Is there any kind of an analytical framework that we can use to establish that instead of just looking at descriptive stats and the graphs? So that's the challenge that we were facing. And I do admit that this was done because we just wanted to figure out if it can be shown at all, but it's not the most perfect way. And that's completely valid. But the challenge is, can we do something, anything like a quantile regression or anything like that to bring it out?
Sorry, Shorish, can I just parse that just for a moment, because I know that Yesha is waiting and she is in the midnight plus zone. So Yesha, can we get your comments, please?
Oh, this is the time I'm awake, actually, more than the morning. So this is fine. But I really enjoyed the paper. I'm really enjoying the discussion, the questions. The other aspect in building on Suresh's point is what is the role of the bank dealers that are the purchasers in this market? And specifically, what I'm interested in hearing is to what extent do their own balance sheets constrain how much they're willing to buy and what kind of prices they're willing to put in these bonds in particular? Is the PSU bond that they're buying subject to lower capital costs for them? Is there sort of lower haircuts for them for holding them on their balance sheets? I think the point was made earlier that these are more tradable bonds, the PSU bonds. So is there a lower capital cost that would incentivize them to buy these bonds and crowd out the private sector bonds? In addition, it would be interesting to see to what extent these bonds act as collateral in the market, and whether the PSU bonds constitute a higher form of collateral, a stronger form of collateral as a safe, quote unquote, safer asset relative to corporate bonds. So do they attract lower haircuts in the PSU, attract lower haircuts in the repo market, for example, in the lending market further on? So how does that affect buying and pricing in the primary market for corporate bonds? The other aspect that I would be intrigued by, and I think I know the answer to this, but to what extent is there some kind of derivatives market or CDS market that can potentially help or assist with pricing anomalies? Or do you see potential for this market growing in the future?
Okay, so quick answer. There is no privilege on capital to PSU bond. AAA have risk weights of 20%, AA of 50%. As per bank capital regulation, no difference between PSU and non-PSU. So all AAAs are alike. And I think similar insurance, I don't know, but I don't think it's going to be different. So yes, in terms of repo market, yes, the haircuts are slightly low for PSU bond, but that's the causality is reversed. That's because their pricing is better. So it's not that there is any third reason for that. We don't have a CDS market. It doesn't exist. In fact, just as an aside, I got into this whole issue with the noblest of all human motives, which is desire to make some money, which pushes me to look for mispriced assets. And when I looked at it, I thought there is an arbitrage that is to be taken out. But unfortunately, we don't have secondary market and instruments to take that out. So that's where my thing started. When then Rajeswari told me that beyond my crass objective, there is a research question here. So the simple answer is that there is no CDS market. You can't take these arbitrages out. In fact, there are other, even in the government bond market, there are huge arbitrages that exist in India, which we cannot take out. So if you look at off benchmark and benchmark government bonds, there is 30-40 basis point difference for just 6-month maturity difference. And that arbitrages persist because we don't have instruments to take them out.
Thank you.
Okay, Sharish, you want to go? And after that, we get lunch.
Yeah. So my suggestion is instead of jumping for the statistical model like one-tail regression, I mean, don't go for that. My suggestion is rather come up with a much more having a simpler model, but a much more exactly explainability of the model is very important. For example, one of the age-old tested model, it's say in equity market, it's capital asset pricing model, because we can explain every term of that model. And what is that? End of the day, it's a simple linear regression model, right? So I think coming up with that kind of model where you can say that, okay, effectively, if you're looking for the credit spread, what is credit spread? It's basically you're looking for alpha, right? You're looking for, is there an additional alpha which is non-zero? So if you can think in that perspective, I think you
will. Just that unlike equity, it's non-linear, number one. It's pricing it's a default probability, not income risk. Equity returns are linear, which here they are not. There's 1-0, there's binary. So it's slightly different. That's why you don't use bond betas. Yes. Because they don't work in a
and that's why they have this convexity and durations and all those other measures.
So I agree that OLS is not the right one. But I don't know whether CAPM kind of approach also would be significantly better.
CAPM was just a suggestion.
Okay.
So maybe development of the model with respect to the convexity and duration would be a much more right way to go, instead of like modeling. So maybe you can just try to model if the duration and the convexity of the bonds, corporate bonds, has any alpha effect. If you can model that, that will probably.
Yes, I think maturity kind of 80% captures that.
Yeah.
Because duration is like 80% of maturity.
Exactly.
Okay.
But yeah, I mean, you can look at it.
Okay, people.
All right.
Right. Thank you very much, folks, for all the presentation, discussion. Yesha, as always, thanks a lot. Now go to sleep. And we're
Oh,
going
I'm
to.
not sleeping. Maybe I'll try and come for the panels. I don't know.
Yeah.
I haven't had dinner yet. I've not even had dinner, so I'm good.
Okay, fine. So we'll meet back here in about 45 minutes.
Just one small point. I think Harsh already agreed with me that if maturity covers about 80%, right? Duration, right? So that means your adjusted R square will shoot up to the at least 70-80% there. So if you model through there, so you need to bring duration and convexity in your model. If you do that, then that means your model explainability is going up, your adjusted R square will go up, and then you can see what else is left out. And that will bring your thing much better.